Good morning, Richard Calhoun, Creekside Realty, here to discuss the Silicon Valley real estate market. We're looking at the active inventory. That's the bold gray line here. You can see it's going down. It typically goes down. The question is it going down more rapidly or less rapidly than normal? And you read that off the right-hand axis. Right now, we have just under 3,700 available properties. Moving on to offers accepted, that's the bold orange line, and surprisingly that's turned around and gone up, but we're selling just right about 2,300 offers in the past, I guess that would be past 5 weeks, and that would be in the Ford County area, and that would be both types of property. Now we're looking at DUI. This is the biggest indicator. This, I would normally put this first, but it's based on the ratio between active listings and sales, so it makes sense to see what those are first, even though this is the more important one. And remember that most of the time up and to the right is a good thing, an improving marketplace, but for DUI, down and to the right is actually an improving or an accelerating marketplace. And that's because the lower the inventory, the quicker it's selling. The quicker it's selling, the more pressure buyers are feeling, the less pressure sellers are feeling. So you can see it has gone down at this time of the year. And one of the questions you should be asking yourself, does it normally go up or down at this time of the year? And we'll find that out with some of the comparisons later on. Here's the DUI of each of the four counties. You can see that Santa Clara County and Alameda County are right on top of one another. I made Santa Clara County a little wider so you can see the blue line behind the orange line, but all four counties are moving downward. What is somewhat interesting is you can see that they all broke pretty sharply, but they also broke at different time frames. Different weeks is when each one of the counties started to improve. They were all going up, which is a slowing down of the marketplace, taking longer to sell your existing inventory. Now they've all clearly changed, and they're dropping pretty rapidly. And again, the key is we're coming up to one of the first major holidays at the end of the year cycle, and real estate's negatively impacted by the holidays. So is this simply the holiday impact? Now what we're doing is flipping over and taking a look at the magnitude of overbidding. This is how much pressure the buyers are feeling. And you can see all the counties have come down dramatically. But again, you can see here in the case of Contra Costa County, it was the last county to roll over and go down. And the first county probably to start going down was Santa Clara County. San Mateo County may have plateaued. San Mateo County may have plateaued first, but it really didn't roll down until after Santa Clara County rolled down. And, you could actually argue, where did Santa Clara County roll down? But you could clearly see there was a change in the air, and that was all before April the 1st, except for the case of Contra Costa County and also Alameda County. The East Bay was a little bit slower, lagging behind a little bit. Now what you're looking at is the sale price to list price distribution for each week. The outside lines are your best week ever back here, April 12th, 2020, just earlier this year, April 12th, 2022. Now, before I added in Contra Costa County and Alameda County, it was March 26th. So you can see adding in the two East Bay counties delayed when the best week ever happened. And, that's one of the things that happens with statistics is, it's just a benchmark of what's going on. And then this is the worst week we ever had, which didn't get changed, which was November 30th of 2001, right after the World Trade Center we were starting to get into that nesting surge that we had. But after that, what you have is the dotted lines are being the oldest, followed by the dashed lines, and then the solid lines are the most recent. The red up arrow indicates the market's improving that week, and the down blue arrow means the market's deteriorating. If they're both on there, and it's plateaued. And the reason it's plateaued, you can see all the dotted lines up here. You can see several of the dashed lines here, but there's several that are missing, and you're only basically seeing one solid line, and that's because they're all falling on top of one another, because the market conditions from the buyer's perspective really hasn't changed. It's changed dramatically from where it was earlier this year, the best week we ever had, and it's approaching, but not very close to the worst week. And you might say graphically these are pretty close together, but it takes a lot to move the market down. You can see that we hit a plateau several weeks ago, and we haven't been able to move it any further, even though a lot of people would say the market is actually deteriorating. But based on the pressure buyers are feeling, it really isn't. Here's looking at the sold price of each county, and then I've added on their horizontal lines so you can come back and see where what prices we currently are at. So they basically, for the most part, the prices were first reached in April of 2021. In the case of Santa Clara County, you can look at 2021 pricing and then subtract a little bit to get down to current level. San Mateo County, you have to subtract a lot more. Alameda County is in between the two. And Contra Costa County would be right on where they were in 2021. So each county is performing slightly differently. This is a new slide. It's just a logarithmic scale. And the major reason I put it out here is the vertical separation here should stay roughly constant if you believe that all areas go up and down at the same rate. And for the most part, when you look at this, because we're going about 14, you can see that the trend lines are pretty noticeable. The one thing I wanted to point out is look at how much closer the blue Santa Clara line is to the San Mateo County line. And Santa Clara County really hasn't pulled away from Alameda County. What this is really showing is San Mateo County has underperformed the other three counties most recently, basically since the beginning part of this year. Because even back here in 2021, the separation appears to be roughly the same order of magnitude. But once we got into 2022, San Mateo County seemed to underperform the other three counties. Here's actually data for you. The green lines are the more significant lines. So inventory is down overall for the single family homes by 5%, also down by essentially 5% in the condo market. Then you come down to 5-week data, because 1-week data, in my opinion, is just too fluctuating to be able to tell anything. So you come down to your 5-week data, and overall single family homes is down 3%. It's down 4% in the condos. That may sound like it's performing very similarly, and in single family homes, it really looks like it is. But let's come over and look at condos. You actually had an increase of 1.4 in Alameda County as far as the number of offers accepted, but you also had a 12.8% decrease in San Mateo County. And that is based on the 5-week number. If you start going up to the 1-week number, they're all over the place. You got a positive 60% to a minus 38%. So that's the fluctuation that you see and why I'm such a fan of the 5-week data. Then you come down to closed data, and more data is significant because you learn things like the sale price. So you have median days on the marketplace, you have the sale price to list price frequency, how common is overbidding, and you can see it's sitting at 40% for the 4-county area. This ratio of overbidding is 100%, and you can see it's down to 99% for San Mateo County, which is the lowest, followed by Contra Costa at 93, followed by Santa Clara County at 99, and Alameda County is at 100%. And then you look at the median price, and what a lot of owners look at is the appreciation. And right now you have an 18% appreciation, which sounds fantastic for a 2-year period of time from the entire calendar year of 2020 through the current week, going back 5 weeks. But if you look at what the peaks were, which we will later, and look at what we are at now, it's really not very pretty. So what we've been talking about is Bay Area data, single family homes, mostly 4 counties in Santa Clara County, Alameda County, Contra Costa County, and San Mateo County. I used a 5-week reference period, and my calendar year, my medians when I'm comparing it to things, is from 2014 through 2021. With that, I'll go over my green URL. That's my base URL. You can go back and look at the archives of everything on YouTube. If you add in 2022 for the year, you get to the current presentation, and that will become 2023 at the change of the year. If you put in H 2022 11/19, you get the handout. It is up and posted. And if you put in the year, month, and date code after the base green URL, you get to any specific episode. My contact information is there. And does anyone have any questions? Not seeing any unmuted mics. And now if you have questions, interject as we go along. Here what we're adding in is historical data. We're looking at the 10 percentile, 50 percentile, 90 percentile over that 2014 through 2021 time period. So the black line here is what you'd expect DUI to be. The blue line up here is the second worst year we had, is the way 10 percentile works. And red turns out to be about the second best year. So we're having a year that is worse than essentially the worst year we had. If I was using the current data, 2022 data for my historical data, it would be basically showing right on here, which is why I don't put in the current year. But you can see that you're following the trend. This is the downslope that you normally have. So what I would point out is the downturn is happening later in the calendar year than you'd expect it to happen, but it's much sharper than you'd expect it to have. In other words, I'm maintaining the drop from here to here is much steeper than normal. The other thing to keep in mind that I think is a fairly significant impact, specifically on DUI, is every holiday negatively impacts real estate. Thanksgiving is on the 24th this year, if I'm not mistaken. Thanksgiving is still a major impact, and the reason it's more significant this year is it's all the impact is this 1 week, where when you look at the historical data from 2014 through 2021, the day that Thanksgiving fell on changes, which sort of mutes or averages out the downturn that you would see for Thanksgiving or any holiday. Here's the delta DUI. This is where I take the DUI for the 4-county area, subtract it from the median for the 8-year period of time. And so you can see we were having a higher DUI than we normally were, and we were increasing it. So here you can start seeing the decrease. So this decrease is what the additional decrease DUI is having, because it was having a completely normal year compared to the 14 through 21 time period. It would be a horizontal line because you're subtracting off whatever the value normally is. And when you're at the completely normal year, you're down here. A horizontal line is unchanging from the historical year. A line that's horizontal and at the black line is exactly that normal year. So you're having a slower time frame right now, but you're accelerating more rapidly than you normally do. But you're still somewhere around 18 days slower. And when you're talking about a DUI that's probably somewhere around 35, 18 days slower is definitely significant, even though a DUI of 18 plus 35 is like 53, is still solidly in a balanced marketplace. It's just we were in such a hot marketplace for so long, the market adjusted to a hot marketplace, and that's what people's perception is. Here's the DUI of each county, and again, it's hard to see Santa Clara County, but you can see the blue hiding out behind the orange through here a little bit. But again, you can see each of the 4 counties is improving. This is now looking at offers accepted, and the same concept. The black line is where you'd expect offers to be at this time of the year. The blue line is the worst you'd expect offers to be, the lowest you'd expect it to be. And the red line is the highest number of offers you'd expect. In reality, we're down here. So we're at 2,000 listings being offers accepted when you normally be accepted up around 3,000. So we only have about 2/3 of the inventory you'd expect. And if you actually look at what you'd expect, it's closer to here, probably about 35, 36. And you're probably a number somewhere around 23. That's just about 2/3, 1/3. So you're missing about 1/3 of the activity. That basically says we could lay off 1/3 of our loan officers, 1/3 of our real estate agents, 1/3 of our escrow officers, 1/3 of our lenders, 1/3 of our termite guys, 1/3 of the home inspectors, and we would still have the same workload. Workload is definitely down, which is why organizations like Compass and Redfin have been doing layoffs. The Delta offers accepted, so this is the difference between the median. You can see you came down and you were quite a bit lower. Actually, the number's right here, 1,500, it looks like it is. And now it's improving, and you're probably up some number around 1,150 or 1,200 fewer offers than you'd expect to have at this time of the year. This is the offers of the 4 different counties. San Mateo County is the lowest, not because it's doing the least, but because it's the smallest county. You can see in general, the 3 counties being Santa Clara County, Alameda County, and Contra Costa County have roughly the same magnitude of transactions. This is market share. This is interesting because you can see that Santa Clara County is becoming a smaller percentage of the market share, which indicates Santa Clara County is getting hit harder on the decrease in the number of offers than the other counties. You can see that historically they're pretty similar. They follow the same pattern. Alameda County was basically going up, and then it leveled off, and then Contra Costa was going up, or Santa Clara County has been going down basically since a little bit before October 1st. San Mateo County is pretty flat and a much smaller county in size. This is your active inventory. Now you're seeing that your active inventory is very similar to what you'd expect it to be. Even though we're having a shortage of buyers, we're not having a surplus of sellers, because the sellers person said, hey, the market isn't so good. I don't have to sell. I'm not going to put my house on the market. Buyers don't have a lot of more choice, and you normally expect more choice in a slower marketplace. You'd expect inventory to grow up, and you can actually see that we've had a shortage for almost all the year. We got up to exactly normal, then we got down, and now we're basically approaching normal again. Here's where I take the delta for the 4-county area for the time of the year, and you can see if we were at a completely normal level, the median, you'd be at the horizontal line. If you were horizontal at any point, you're moving up and down relative to what the market would normally do. In this case, we're climbing and we're below. What it's basically saying is you're starting to get more and more active. You still have less inventory than you'd expect to have for this time of the year. Here's flipping over and looking at what the buyers are feeling. This is their pressure. This is what highest 97.5 percentile overbidding. This is basically correcting for misreports of sale price or list price to give you an idea what the maximum overbidding is. So the maximum overbidding, and by maximum, it's the 97.5 percentile overbidding. So 2.5% of the transactions are higher than that, but I did that intentionally to get rid of the transaction that's off by a factor of 10, 100, or 1,000, or 10,000, which happens more often than you would expect. I try to correct all that data points, but every once in a while, one or two will slip by when you're looking at 500,000 records. And so by taking the 97 percentile, I define this as my quasi-mat. And similarly, down here is my quasi-min, 2.5% in to get rid of errors. 95% of the transactions are selling between about 88% and somewhere around 128% of the seller's asking price. Then you move into the paired gray lines, which are the 90 percentile up here and 10 percentile down here. So 80% of the homes are sold in this bidding area, which is a much more compact zone. Then you go to the pair of green lines. This is your 25 percentile, and this is your 75 percentile. So now 50% of the homes are sold somewhere between about 96% and call it about 103.5%. So you only have about an 8% range where half of your homes are happening. So you can see that for the most part, sellers get what they're asking for. And that's because a lot of sellers aren't willing to play the game, which I'm not sure is a good game to play, of dramatically underpricing the house and allowing the market to bring it up. Now, obviously, every particular seller and buyer is a different situation, but in general, at least it's my opinion that the way to maximize the price and get a reasonable quick sale is try to really pinpoint the market value, which is really hard to do in a changing marketplace. But pinpoint that as much as you can and then mark it down 1 or 2%. What that does is that people says this is a good buy, the value's there. If I don't buy it now, someone else will. So your offers come in quickly. There will most likely be, even in a slow marketplace, because even when we were in the world trade slowdown and the worst slowdowns we've had, there's 15% overbidding because of people pricing their property aggressively. It all depends on magnitude. It all depends on the market conditions and everything else. And that's hopefully part of what you learn by this is what the market conditions are. Now we're looking at the delta of the magnitude of overbidding. So again, you'd be on the black line and horizontal if you're having a completely normal year. You can see earlier in 2022, we were way above the level of overbidding you'd expect to have, somewhere around 5.5% over. Then earlier this year, right around August 4th, you were way below. That's 2.5% below. And now you're slowly climbing back up. And now you're about 0.75% low. Part of this is as sellers get to adjusted to the new market better, they really adjust their sale price. And so the sale price to list price ratio starts becoming in tune with the long-term averages. Here is each county, and you can see that 3 counties are right down where you expect them to be at essentially 100% and performing almost normally. The one exception is Alameda County. It's out here, and on average, the sellers there are getting 4% above their asking price in this marketplace today, which I think would surprise a lot of buyers and a lot of sellers. For whatever reason, it could be Alameda County is more affordable. Contra Costa County is similarly more affordable. It could be that Alameda County is slow in coming down in their market conditions. It could be any number of things, but the thing that this does is report what the market's actually doing. Now you're looking at the overbidding compared to the county, so you subtract off the county. So you can see these 3 counties are below the 4-county median, and that's because Alameda County is above. If someone's above, someone's got to be below. In this case, you have 3 that are equally below, so they're doing very similarly. And again, Alameda County sticks out as way overperforming the other 3 counties. Now we're looking at the overbid week each week. So this is the current week. The purple line can see that 50% of the sellers are getting less than their asking price. You can see that roughly 40% of the sellers are getting more than their asking price. You can see the top sellers getting about 120% of their asking price. The worst seller over here is getting somewhere around 91% of their asking price. This is the best week we ever had. Again, that was April 12th of this year, 2022. This is the worst. What we're going to do is we're going up as the market's improving. We're going to add in 1 week at a time. And we're just going to automatically step through. The green box is the date so you can see it. So now this is going back 1 year ago. So you were significantly better. And with that, I'll let it step through. 11 months ago, 10 months ago, 9, 8, 7. You can't see it, but if you come down here, it's right there. 6 is now basically plateaued. Now we're coming down quite a bit. It's right here, down 4 months, 3 months, first dashed line, 12 weeks ago, 11 weeks ago, and now starting about 10 weeks ago, the change, you can see that one, but in 9 weeks, you can't see it, and that's why the plateau. It's all getting plotted on top of the purple. And if you look up here, you can see a few lines very close up here. And this is labeled plus 1 week, but it's only through today. And that's because this is the data based on my real estate fiscal year of March 1st. November 15th is comparing November 15th of every year. You don't have a week ending on November 19th. So I call it plus 1 week. And, you really can't see the line anyway. So it's not that I'm predicting the future. It's just bringing it up today because the 15th, I think, was about Tuesday of the week. It was 4 days. Yeah, it was 4 days ago. And I just want to give you the current data through midnight last night. So it's there. You can't tell any data. The purple line is the comparison because it's the equal comparison. And that's why I think it's the most significant. Now you're looking at the frequency of overbidding. The blue line, that's the bold line, is the number of sellers that are getting more than their asking price. So you can see that it peaked, sort of hit a plateau maybe for the month of April minus a week or two. And then you can see you came down here. You now have less than 50%. You're just about 41% of your sellers getting more than their asking price. Now you're looking at the bold brown line or orange line, and you can see you're not quite at 50%. You're about 48% maybe of the sellers are getting less than their asking price. Then you're moving on to the gray line down here, and you're getting basically 10% of the sellers are getting exactly their listing price. Here's the overbid frequency of each counties. You can see overbidding in Contra Costa County is significantly lower than San Mateo County and Santa Clara County. You can see Alameda County is at 50% and outperforming the other 3 counties. And that's on frequency of overbidding. How common is overbidding? Here's the overbidding subtracting off the median. So you can see Alameda County is doing the best. You can see San Mateo County and Santa Clara County are doing roughly the same. And Contra Costa County is doing the least well. This data is simply showing the number of offers that were accepted. And because of its offers accepted, you have transactions that fail, you have late reports. But what the takeaway is, the big first takeaway is last week I reported we had the fewest number of offers out of the last 25 years. And now it's reporting as the 24th. I think what happened is last week was Veterans Day. So a lot of admin staff had Friday off. A lot of sales that were normally reported would have been reported on Friday, didn't get reported till Monday. So they reported them correctly as happening the week before, but the actual reports didn't happen until Monday. So we went from the 25th worst year to the 24th worst year. We're at 650. And if you go back here, you were at 604 in the year of 2007. And from memory, I think this was down like at 558. We picked up almost 50 listings. We picked up almost 10% of the sales that happened last week, a full week ago, but we picked them up after Friday night at midnight, which probably means Monday morning we picked them up. but we're the 10th worst year out of the last 10. Now we're the 10th worst. We also have the fewest. We don't have a holiday, so I don't expect to have to adjust it upwards. And I didn't copy forward the number, but I think it's at 602 or something. So you can see that again, we're at 554. Our worst previous year, I think, was 602. I should have brought that over here. And I didn't, with 604? Yeah, I don't know what it was, but it's the lowest and it's off the screen because I can only fit 10 years on here. And so the blue are cold marketplaces, but honorable mention. Red are the red hot marketplace, the best year we ever had. And then the yellow is the current, but when I make this the blue, because it's now the coolest marketplace we ever had, it overwrites the yellow. The shocking thing to me is we went basically from the best year just a year ago, very quickly in a span of 2 years, to one of the worst years. And this was basically the second best year here. So we went from the second best year to the worst year in 1 year, which is pretty amazing when you think about it. Now we're going to look at blended data, which is single family homes, condos, and townhouses, San Mateo County and Santa Clara County for a 5-week period of time, all put up in a blender and mixed together. This is looking at DUI for this single family homes at the top, condos and townhouses at the bottom. The redder the color, the hotter the marketplace, the bluer the color, the colder the marketplace is. I did adjust the DUI on the blue side, as I discussed last week. So even though this blue here is saturated blue and this is close to saturated blue, but not quite, this is worse because this week my saturated blue happened at 110 days of unsold inventory. Now it's happening at 135. That was the only one that's going to be visually impactable. And I think I made the adjustment for the better for the long term, because now you can see the huge discrepancy between 135 days, I think it is, and below 40 days. Here's your days of unsold inventory, 135.3. So you go from basically 32 days of unsold inventory in Cupertino and Sunnyvale to 135 days of unsold inventory in Menlo Park and Atherton. So a 100-day range, very atypical to see that kind of range. You can see the heart of Santa Clara County is still sort of a pinkish color, which suggests it's still a seller's marketplace. It's only these blue areas that are starting to become a marketplace based on DUI, which is, I believe, one of the best indicators. Here's the magnitude of overbidding. Again, when you have red, you have a lot of overbidding. When you have blue, you have very little overbidding. Basically, the overbidding is below 99% in order to start having bluing. So sellers are taking on average at least a 1% hit anytime you see any shade of blue. Here's the frequency of overbidding. Here, you have to be below 33% of the sellers to be getting blue. So you can see in the Cupertino-Sunnyvale area, more than 50% of the sellers are getting their asking price, and you can see it's 55. You can see a lot of the areas are below 33, so they have some shade of blue. This has nothing to do with the speed of the marketplace. It has everything to do with price of the marketplace. Redwood City is your median price for the area. The redder the color, the more above the median price it is. The bluer the color, the more below that median price it is. The chart over here shows you the median in the middle. The number to the left is the lowest 10 percentile you'd expect. The number to the right is the highest 10 percentile you'd expect. Here's your micro market areas for single family homes in both counties, condos and townhouses in both counties, the DUI you'd expect, the magnitude of overbidding you'd expect, the frequency of overbidding, and the price you'd expect. So you can start with your price range or your geographical area and quickly learn what the market conditions you'd experience are. Here's a table. Red means you're in a red hot sellers marketplace based on that one indicator. So inventory in Santa Clara County at essentially 83% is below where you'd expect it to be. That is a shortage of inventory. When you have a shortage of inventory, you'd expect it to be a hot marketplace. Doesn't mean it is, because the buyers that are out there are going to impact it and everything else. In San Mateo County, you're at 113%, which is within my balanced market range. In Santa Clara County condos, you just went over the 115%. So now that's a cool marketplace. You have a surplus of inventory, so the buyers shouldn't feel the competition. Then based on DUI, which I believe is the best indicator, you're at 49. Anywhere between 40 and 80 is a balanced marketplace. All four indicators are in that balanced marketplace. The high is the Bay Cities at 68 days. The low is at 49. So pretty well behaved when you look at DUI. Magnitude of overbidding, again, everybody's in a balanced marketplace from Oh, actually, that one slipped by at 98.4. It should actually be blue in color. The Redwood City condos is a buyer's marketplace on overbidding magnitude. 99 to 101.5% is balanced. So 3 out of 4 are balanced. Coming over to frequency overbidding, 33 to 50 is balanced. And again, this should be blue down here. I guess Redwood City condos decreased this last week, and I didn't notice that. So this should also be blue. I'll change that for next week. Then if you look at appreciation, appreciation is blue, not because 16% appreciation in 2 years is bad, but you were at 43% just earlier this year. Now, Redwood City condos at -2%, you've lost 3% of your market value in the last 2 years, and that's not good in any kind of conditions. And considering you were up 17.5% just earlier this year, it becomes that much more stark. You basically have lost close to 20% of your value from your peak. Here's not completely comparing apples and apples, but you're trying to look at November data, which is not available in December the 6th, because I need 30 days in November plus 5 days in December to get 35 days. How am I getting this day? I'm taking last night at midnight, going back 35 days. The 2022 is not comparing apples and apples, but it allows you to get some idea. The big ones that I would want to take away is days of sales per day, 16.9. If you come back, you won't see any number lower than that. You won't, the closest you see is 2007, and it was selling basically 2.3 more houses every single day than we are now. So this is the least number of offers that we've accepted. And also when the market's down, you can have a higher TFT ratio. And then the other thing is number of closings at 673 is not the worst we ever had. You only had 589. That indicates that the market's still been slowing down fairly significantly in the last 5-week period of time. Because back in 2007, you had fewer closings than you did in 2022. Fewer closings in 2007, but or say more sales now in 2022 than in 2007, but fewer offers. That shows you that the market's slowing down. If the market was sort of following normal trends, they would both be the second worst year we've had. In this case, closings are the second best, offers is the worst. And for those that want to be purist and compare apples and apples, this is the October data. And with that, if you get on early, this is the slide that will greet you. Ignore the date. With that, we're back to my URLs, and I'm open for any questions that anybody might have for me. Not seeing any unmutes, I will call it a day. Have a great week. Hope to see a few people next week. Take care. Bye now.